Right now, joining us for more on what we should think about the banking sector after hearing these results over the last couple of days, also the state of the U.S. market and the economy. Let's welcome Mohammed El-Erian. He joins us right now. Of course, he is Allianz Chief Economic Advisor. And Mohammed, it's great to see you this morning.
Good morning, Becky.
All right, thoughts on the banking sector. We kind of knew these reserves were going to be taken. The amounts are all over the map, but J.P. Morgan may be being the most cautious and kind of conservative on this entire situation. But what do you think now that we've had so many of them that have reported, J.P. Morgan, Wells Fargo, Citi, and Bank of America?
You know, they're all consistent on three messages. One is very large loan loss reserves. J.P. Morgan took $8 billion. Citi just took $7 billion. Bank of America took $5 billion. These are large numbers, and they're expecting what J.P. Morgan called a severe recession. The second thing is that trading did great. March in particular was a very strong month, and not surprisingly, bid-offer spreads exploded, and the banks were in the middle intermediating. And the third, it's reopening an old debate, narrow banking versus universal banking. Turns out it helps to be diversified, which is the opposite of what the discussion was back in 08-09. So I think it's really interesting, but the message are very, very consistent.
Do you think this is a case of them actually seeing a huge recession that's going to be taking place because of these charges, or do you think this is a case of them being conservative in that instance?
I think it's both. I think they expect, the IMF expects, everybody expects the worst economic hit since the Great Depression, and that's a big statement. But I also think if you've made a ton of money on trading, you really don't want to show massive profits right here. You don't want to say, hey, look, I'm doing OK, while there's 17 million people who have been unemployed in the last three weeks. So it's a good time to take loan loss provisions. So they're both able and willing to take it.
Mohammed, what do you hear about what's happening in Europe with the banking system there, the potential exposure the banks here might have? Is that a big issue at this point? Is it something we need to be concerned about, or should we feel fairly good about where things stand?
So I missed the first part of your question. I apologize.
That's OK. The European banking system, I know there have been some questions raised about that. How much exposure do our banks have to that?
So we don't have much exposure to that. The European banks, it depends where you look. Different banks are in different situations. I think the big message that came out very clear yesterday is, A, the banks want to be part of the solution, not the problem, and that's a big difference. B, they need to be, because there's a massive credit squeeze that may develop if we slow down enormously. We don't want liquidity to become a solvency issue. But the third issue is really tricky, and the Fed faces it today. How much credit risk should you take on your books? And how much should you take on, and how much should somebody else take on? And that's a really tricky issue.
Mm-hmm. I guess that gets back to this question of how soon the economy reopens. Some talk yesterday that there are some states that might actually open up before the beginning of May. I guess it's hard to try and figure out what the quantity is going to be in terms of how much business comes back. And I guess what the lag time is before we get back to some state of normal. What's your best guess on this right now?
So it is a guess. I think most of us see a gradual return. It won't be spontaneous. It won't be instantaneous. It will take time. There will be hiccups. It's not easy to restart an economy. The one thing that we haven't talked about is the risk of a W. And that is something I really worry about. What if we reopen and then end up like Singapore, having to shut down again, end up like Hong Kong, seeing infections go back up? What would we do then? And, you know, there's a balance of risk. I'm glad I don't have to make that judgment. I think it's one of the most difficult judgments to make. How much economic risk to take versus how much health risk. That's a really tough call. But we're going to have to learn. We're going to open. We're going to learn. We're learning every day. And that's positive.
In terms of needing testing coming back, do you really try and figure any of this out? It's difficult to watch the different lines of thinking on this, whether it be, we were just talking with Sam Waxel about the idea of testing antibodies so people can know if they've already been exposed and maybe feel a little safer about going back, or generalized testing. It just seems like there is some sort of a new normal, to borrow your phraseology, that's going to come in when it gets to testing and what we should get used to.
Yeah, we should get used to testing. And I think the hardest thing is, will we accept as a society the notion of a health passport? Will we accept carrying something that says, I've been tested, I'm fine, and I'm open to be randomly tested. Are we going to accept that or not? If we do, we can reopen more quickly. If we say, no, I don't want that, it's going to be harder.
Do you look at certain sectors and think, OK, these sectors are more likely to rebound pretty quickly? Jim Cramer said yesterday on our air that he thinks you need to be a stock picker more than ever, not just buying blindly the S&P 500, like indexing has been so popular for the last decade. But the idea that there are going to be some serious winners and some serious losers, some areas where things rebound more quickly and other places where it's a lag that could last for years.
Yes. And you see it already. The S&P has done a lot worse than the NASDAQ so far, and for good reason. NASDAQ companies in general have better balance sheet, are better positioned for the shift to virtual. U.S. has done much better than emerging markets, and for good reason. I think the relative call is easy here. The absolute call is a tougher one.
Absolute call meaning when we're back to all clear all the way around?
Yeah, where do we go? Are we going straight up again? Are we going straight down again? That's why I've liked the up in quality trade. Keep a claim on the upside while protecting against the downside. But the relative trades are working out well, and they're working out according to balance sheet. Where are you going to be on the other side of this crisis? And how good is your management? And we're seeing that over and over again play not just within the U.S. markets, but also U.S. versus the rest of the world.